Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. McIntyre Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial investment and retirement futures. He is Chris Mcintire, president and founder of McIntyre Retirement Services, helping us to navigate this crazy, complex financial world. And we do need a game plan, Chris. We're glad you're here to provide it.
Yeah, we certainly do this year, Peter. And, after 2020, it's rocking and rolling right into 2021, or we're up 700, we're down 700, and everything starts looking good. And then all of a sudden somebody talks about inflation. Somebody talks about, bubbles and that kind of thing. So sometimes I just wonder if we'd be better off without all the social media.
Indeed. And Chris, I saw an interesting graph the other day that talked about the probability of outcomes and how it's gotten much, much wider. And they showed different time periods of the market and the top to bottom fluctuations, and how in times past, even though the market did move, it was in a relatively kind of narrow margin. But recently, over the past 5 or 10 years, those margins, the top to the bottom, the peak to the trough, have become that much wider. And that's our range of possible outcomes that is less and less certain, it seems.
Yeah, it really does, Peter. And then you throw in the Bitcoin side of things, or the cryptocurrency, to be more general, and the speculation. Is that a real technology for currencies? Is that going to take over, or is it going to implode? And that's kind of, it seems like everybody is either on one side of that argument or way over here on the other. No one's in the middle saying, yeah, it's got a place in here. And I think we can see how it all works out. But I think it was you. Was that you telling me that, was it Mass Mutual bought a whole bunch of it? One of the major life insurance companies, or I read it someplace.
I think, yeah, it was not me. I know that there are several major institutions that are buying it up at a pretty alarming rate. I know Elon Musk made a huge investment in Bitcoin, and I know that there was another venture capital hedge fund manager that was buying like $10,000 worth every 2 seconds or something like that. It was a crazy amount. And he did that over a period of several weeks. So yeah, it's here. We don't know if it's here to stay or what the value is. I hear that most people who are using it are kind of just putting money into it and using it as a store for value that is somewhat inflation protected, I guess.
Yeah, absolutely. And, technology changes, or certain patterns of investments are going to change as well. We saw that with the GameStop and AMC theaters, as, a bunch of ordinary individuals, bet against the short sellers, if you will, the hedge funds. And, kind of an interesting, what do we want to call that? A David and Goliath going on there?
A little bit, but then they turned into the very Goliath, it seemed, that they were battling against.
Yep, you're exactly right. So the law of unintended consequences.
Well, that's why we say this is a crazy, complex financial world. A lot is uncertain and unpredictable, but one part of it is certain, Chris, and that is that the tax deadline is quickly approaching. It is upon us. We all want to save as much as possible, I think, and pay as little as possible in taxes. How do we control that tax bill? That's really on a case-by-case basis. We want to do it morally. We want to do it legally. We want to do it ethically. But Chris, I think the way that each one of us individually controls our taxes or addresses those taxes is really up to us as individuals and up to our situation and circumstances.
Absolutely. And, creating a tax efficient portfolio or a withdrawal schedule certainly is in a client's best interest. And, people that are still working right now, their deadline is April the 15th, where contributions to IRA accounts can go in. And I'm going to say this because we just emailed all of our clients that do not wait until April 10th to send a check in. the mail is slow right now. The company has to receive that, and make sure you're getting the right crediting date and things like that. So earlier the better on your contributions. Do not wait until April 15th to decide to make that contribution. But for some folks that are still working out there right now, and have a high income, it certainly may make sense for them to do tax deferral into an IRA where they're not paying tax now, but they may pay it later when they're in a lower tax bracket. That certainly can make sense for some folks. Now, we probably have some people out here that, have just been very good savers, even on a modest income, because they've lived within their means for 30 or 40 years, and they have this whopping supersized 401k or an IRA of $1 million, $1.5 million, $2 million. That's all going to be taxable when you pull that out. And, the Internal Revenue Service requires you to pull that money out once you hit age 72. So now we even have longer to defer and create this bigger, let's call it a tax beast for the radio show. It makes sense.
Yeah, but if you don't believe that there is a debt hidden inside your 401k or IRA account balance, just wait till those minimum payments come due. That'll let you know that you do in fact owe a debt to the IRS. And most of us realize that as we're drawing money out on a regular basis. But again, navigating the financial world, navigating planning for retirement, creating income, how much taxes are due, and then on a day-to-day, year in, year out, and especially forward-looking, proactive planning approach, we need to manage those taxes, and we need some guidance and resources to do that. Chris Mcintire is here to help provide those, ladies and gentlemen. If you've got questions, if you've got concerns, he does help his clients put together the game plan for retirement, your game plan for retirement. And if you'd like a snapshot of where you are today, currently, a discussion of what your financial goals are for the future, what you'd like your future to look like, writing those down, documenting those, and then having a qualified, experienced professional to give recommendations and guidance on what steps to take in order to achieve and accomplish those goals. Give Chris a call, 800-868-1194. That's 800-868-1194. That's exactly what he offers to put together for savers and investors across Northwestern Ohio. Listeners to this program, viewers of the show, pick up the phone, give Chris a call right now, 800-868-1194, 800-868-1194. So the questions of, is it best to pay now or defer and delay paying taxes? That can be answered in that game plan for retirement. Will I drop tax rates and brackets in retirement? If I plan to grow my money, doesn't that mean that I'm growing my tax bill too? All strategic discussions and considerations, decisions that you'll have to make, not decisions that you want to make last minute as you are preparing a tax return based on last year's income. So today, Chris talking a little bit more about proactive tax planning, a change in perspective that we really all need when it comes to how we think about taxes.
Peter, I would like to add into that is, you're going to hear the words contributions and conversions when it comes to IRAs. So make sure you're understanding which of those that we're talking about. Earlier in the show, we talked about people that are still working, contributing into an IRA. And as we transition throughout the show here, we'll talk about converting IRA dollars to Roth IRAs. So not everyone can contribute to a Roth IRA, but anyone can convert regardless of your income. So, some of those nuances and the technicalities there, and obviously Peter and I live in a very technical world here. So, as people are retiring now, and, even if you got 5 years to go yet, guys, you want to understand where your tax bracket is right now. What is your effective tax rate? TurboTax kind of computes that for you. And, they do a very nice job for those of you that are do-it-yourselfers. You may know what your effective tax rate. Effective tax rate means after all my deductions and contributions, what is the dollar amount I'm paying on each dollar that I earn? Because right now, we have a 10% bracket, a 12% bracket, a 22, and so on. And then you get the standard deductions that are out there. So, you're not all of your dollars are taxed equally. Okay? But what is the aggregate overall, the effective tax rate? That's very important to know because, that will tell you if you have more room to convert IRA dollars to Roth IRAs, which will be income tax free, which will pass to your beneficiaries income tax free, and do not have mandated required distribution. So number of advantages to the Roth side of things, especially while income tax low are at, historically average low rates right now. And who knows where they'll be in the future. Peter and I, everybody speculates on where they might be 10 or 15 years from now. And if I was a betting man, I'd put money that tax rates are probably going to be higher in the future than they are right now. Somebody's going to have to pay some of these bills with the stimulus and all the things, to get us through the coronavirus, but also the 2008 financial crisis that we haven't necessarily paid for yet either, the unfunded entitlements for the baby boom generation. So, we have some logistical demographic challenges economically where more revenue may be needed. And, guess where that's going to come from? Probably out of the IRA side, because they know where that money is and they know that money's going to have to come out of there, and it's easy to adjust those rates because they're so low. They could say, we're just going to let, the President Trump's tax cuts expire. We talked about that on the previous show last week, and they will revert back to where they had been previously. And, not all tax cuts are permanent. And if you could tell me the tax rate you're going to be in 15 years from now, I might hire you.
Yeah, well, I heard a phrase, a saying, when it comes to retirement, the tax code is written in pencil. And I thought that was very apropos, seeing as all the tax law changes and the suggested changes and the discussed changes that we are hearing about. But Chris, you're right. We do need to know and understand our bracket and our rate. And a lot of people feel like or believe that because they're in the 22% bracket, they're paying 22% tax on all of their income. That's only the last dollar that they earn. There's many dollars before that they may be paying 10 or 12% on, and their effective rate is probably significantly lower than the end bracket that they fall into. We have a progressive tax system, which means the more money that you have, the more income that you create in a given year, the higher your effective tax rate. It's not just proportional across the board.
You're correct, Peter, and it will just we'll dump on the rich here because everybody says the rich don't pay taxes. But, if their income is above, basically $415,000 this year, 35% of all their efforts pay federal tax, where, if your income is below $80,000, you're in a 12% tax bracket. That's a 25% difference on every single dollar. That doesn't include, special taxes that help pay for the Affordable Care Act. It doesn't include a higher capital gains tax rate. It doesn't include, what state, income taxes could be as well. So it's hard to, sit here and just blame the rich need to pay for more of it. It's like, that's not how the system works here. Look at the tax on a gallon of gasoline, look on tax on cigarettes, look on taxes on your phones. I mean, there's so many of these taxes or, fees if you want to. Right. Yeah.
A fee is a tax. A tax is a fee. It's kind of one and the same.
Yeah. Yeah. A couple of 3-letter words there that none of us like: tax and fee. Right.
Yeah. Well, I heard a penalty is a tax for doing something wrong, and a tax is a penalty for doing something right. Either way, you're paying, right?
That's a good point, Peter.
Well, Chris, in order to prepare better for our future, in order to make better decisions about how to save our money, because when we earn money, we fall into one of 3 classifications. It's either brand new earned income, investment income, or passive income. Most of us are earning money and then trying to put our savings into that investment bucket so that one day we can create some investment income. But when we do, there are 3 categories and classifications there. We can do taxable, we can do tax deferred, or we can do tax free. Now, in order to make the best decisions, we have to know where we fall in our brackets today. And we do have to do a little of projecting and assuming on what the tax rate and environment is going to be when we actually use those dollars into the future. And I think that's where we see a big shift going on right now. Would you agree?
Absolutely, Peter. And the default method of saving money for retirement has been the 401k plan, the 403b for those of you that work for nonprofits, the 457 plans for those of you that might work for a government. So, and they've made it easier just because that money comes out of your paycheck and you just put more of it away. You don't have to pay any tax on it. You don't have to worry about it for 25 or 30 years. Well, most of the folks listening to the show today aren't worried about it 25 years from now. They're worried about it in the next today or the next 5 years. Is kind of where we target the demographic here for the show is, now that I've created all this big savings money and mutual funds and whatnot, what are the ramifications when I want to take that money out? Well, it depends on when you take it out and how much you take out. So if it's in a traditional 401k plan, when you pull that out, that is ordinary income tax rates at whatever tax bracket you're in. So some of that money, when you pull it out, might only be taxed at 10%. However, if you pulled out an extra 5,000, that 5,000 might put you in the 12% bracket, okay? Or in the 22%, depending on where you're at, with that progressive tax system that Peter talked about. If you have a Roth 401k, that means you paid the tax on the money going in. You don't have to pay anything on the tax on the money coming out. So that's obviously has got a pretty good end result there, because the best tax rate to pay is 0. Okay. With the tax rates coming down, especially since like the early 1980s to where they are right now. God, in 1980, when Ronald Reagan got elected, the top federal income tax rate was 70%. Today it's 37, half of that, guys. So, why are we still doing the same thing we were doing in 1986 in the year 2021, for example? Things have changed. Have you changed with those favorable tax conditions would be my point.
Well, again, if you would like to make sure that you are thinking this through and being as efficient as possible with your taxes, looking at the scenario you are in currently and mapping out a game plan for retirement over the next 5, 10, 15 years and beyond, and trying to save as much, pay as little in tax as possible, pick up the phone, give Chris Mcintire a call, 800-868-1194, 800-868-1194, 800-868-1194. He does make the offer to put together that game plan for retirement for savers and investors across Northwestern Ohio. Listeners to this program, no cost, no obligation, to get yourself on track or just to double check what you are currently doing. A lot of pats on the back and confirmation that you're heading in the right direction after that process, but a lot of times spotting things that can be improved, things that can be optimized, looking for those holes, those items that have been left unaddressed, and making sure that you're aware of them. If you'd like to go through that process with a qualified professional, again, give a call, 800-868-1194, 800-868-1194. Chris, we've talked previously on the program that taxes are probably one of our largest known expenses over our lifetime. So we want to be as efficient as possible, but I've got a little math problem, and I'm not going to put you on the spot. I'm going to actually give you the answer, but it's what it represents really is the question here. So what is 2 times 3 times 7 times 10 times 52 times 20? And the answer, it's a lot. It's a lot. You're right. The answer is 436,800. Now, the question is, what does that represent? So 2 people eating 3 meals a day, 7 days a week at $10 a meal, 52 weeks a year for 20 years. So food cost alone over a 20-year retirement could be about $436,800 if you go by that rough estimation. Chris, the costs of retirement are going to be staggering, and it's not really going to cost that because we have to pull that money from somewhere and then account for the taxes on it. It's just, we have to plan to be efficient. And I guess that's the point, is that retirement can be very expensive. Why add costs to it when we don't have to, when there are some costs we can control?
And do you know how many husbands are going to leave their wives at home right now and go out to eat by themselves, Peter, because you said that? So don't blame me, guys. That's Peter's idea. But anyway, yeah, you're exactly right. I mean, just, some of the costs are exorbitant. And if you were to take like the monthly payment that you lose out of your Social Security just to cover part of your Medicare expenses, and then factor in your supplement insurance plan that you're paying out of pocket for and the deductibles, they say that that's a easy $250,000 through the average retirement per person. So, just some, as you extrapolate these numbers, they just get huge. Month by month, it might not seem like that much, but, a lot of, I think I mentioned on the previous show that my father-in-law retired at the age of 49, just about 50. He's 92 and he still gets the same pension payment that he got, 42 years ago. So imagine what the inflation piece on that is done. And, I'm sure when he retired way back when, the dollar amount he was getting seemed like a lot of money. And right now
things are more expensive than they were in 1979.
No question about it. And yeah, it's amazing, and so that's the longevity risk has for him greatly enhanced the inflationary risk that he took. And obviously his Social Security, hasn't gone up nearly with the cost of living adjustments. And, right now, look at food prices and things like that have skyrocketed over the pandemic here. And, thankfully there's some resources out there that folks can rely on, but I don't think most of you want to rely on other resources. You want to rely on your savings that you've had. And that's why, as the interest rate environment has changed, as the tax environment has changed, your retirement plan needs to be flexible to change with that as well.
Well, Chris, you've got a list here of several, some of them are last minute tax moves, but some of them are proactive tax moves to control future taxes. Let's run through that. Why is making estimated payments going to make taxes more controllable for some among us?
Well, I'm self-employed, so we have to make 4 quarterly tax payments throughout the year. And for some of you that once you retire, you may have to do that as well. If you take out a big IRA withdrawal to buy a condominium or, a 50, 60, $70,000 IRA withdrawal, and you may end up having to pay quarterly tax payments as mandated by the IRS. So it's important. You don't want to get behind that 8 ball, if you will, because that's what causes a lot of businesses to go under. They just don't budget themselves enough to pay the income taxes and they get into trouble. And, but that's one of the big reasons there.
They're good at business. They're not very good at managing the taxes. And you're right. Unfortunately, that has hurt a lot of businesses and it has hurt a lot of retirees, Chris.
Yeah, because if you're in a 25% tax bracket, that means for every dollar that comes in, you got to take a quarter out of that and put it in another account that you never touch, even when times get tight. And then, and you want to update your tax withholding. So we deal with a lot of folks that, have money come out on a monthly basis and the taxes come out of that as well. And, oftentimes, they have so much taken out that, hey, we get $5,000 back at the end of the year. It's like, all you're doing is getting your own money back. So why are you taking it out in the first place? Because it's not earning you anything when the IRS just cuts you a check for what you overpaid. Whereas if you leave it in your investments, chances are you're going to make more money than that, make money on that over time, dividends and whatnot.
And, go ahead.
And then obviously people have ongoing contributions. So, if they're working, they're putting money into their 401ks, into their IRAs, or even just a joint account, or rebuilding a savings or something along those lines. And, the easier, it's kind of like exercising. The more often you do it, the more habit forming it becomes. And, so trying to stay on schedule with that and having that self-discipline. And, I preach that quite a bit, as Peter knows. I don't drink. I go to the gyms and we go to a lot of conferences together. And before the pandemic, and they'd make fun of me for going to bed at 9 o'clock in the morning, but I'm the freshest one in the morning after a workout, and
up and worked out by the time most of us are getting around to getting that shower and washing last night off. Yeah. But Chris, as you mentioned, not everybody can make certain types of contributions. And so the conversion strategies therefore become important. A lot of talk has been had about backdoor Roth conversions, but if you've got a large pre-existing tax deferred balance, you kind of have to worry about that balance first, don't you?
Yeah, certainly, and deal with that because that could be a big issue down the road. Eventually, it will be because that money's going to get paid out. And, we didn't mention the Secure Act, which was a legislative change that happened in 2019 that changes what happens to these big fat IRAs once people pass away. They have to be paid out faster than they normally would have, in previous legislation, if you will. Okay. Um, the other side, the other topic here, Peter, is we're coming up on April 15th. So, some folks are still making contributions for 2020, and that's where that April 15th deadline that also goes into play with your health savings account as well. You have until April 15th. So you can contribute to your HSA account if you're eligible for 2020's tax burden. You can contribute to your own IRA for 2020's tax burden. If you have a spouse, and you have enough earned income, you can contribute for a spouse's 2020 IRA as well, even if that person isn't working. So a number of different avenues to lower that tax bill, albeit it might be temporarily for 1 year, but maybe that makes the most sense in your particular instance.
But Chris, if we talk to the IRS and ask about what our limits or limitations for those contributions are, they'll say, hey, if you're over 50, you can contribute $7,000. But if we are proactive and looking for opportunities and strategies, again, morally, legally, and ethically, we can double up for last year and this year. We can double up for ourselves and our spouse. We could theoretically get up to $28,000 into those type of qualified retirement accounts to give us some tax reprieve and advantage.
Certainly. And then you can get that money working for you as well. And so, those are some things that my wife and I have done here is, we just ended up having the dollars. So let's get them into work earlier in the investment side of things. And, instead of just having that money sitting in a savings account doing nothing, let's get that in there and take advantage of it right now if you have it. And, many folks have through the pandemic have certainly suffered economic, heartbreak, if you will. Our heart goes out to you. And then on the other side of that, some folks have had the best year of their career, just, being at home, being able to work and, getting some stimulus money from the government and, not being able to spend money on normal things that we're used to.
But other expenses popped up and the tax bill didn't go away. And so we've got to plan and prepare again for our future. A lot is uncertain, Chris, but Benjamin Franklin, I think, said it best. There's two things in life that are certain: death and taxes. And sometimes it feels like we're just taxed to death. So if we can make some proactive strategic moves to control that tax bill, all the better. And I know that a lot of talk and discussion is around what changes may come into the future with taxes. Chris, are you seeing that with your clients, that they are concerned with what the future of taxes and taxation may be?
Yeah. And Peter, that's something that we're going to be, much more proactive right now. And, listening to legislation coming out of Washington now that the administration has changed on, what things could be changing here in the future. I mean, very robust government spending programs are funded by tax revenue coming in. So, we will talk about new tax strategies. And it certainly is a button of concern to try to be politically neutral here and not pick one side or another by any stretch. But being proactive in the tax planning certainly is in clients' best interest, regardless of political party they belong to. And, we've heard billionaires talk about, well, tax rates need to go up. They need to have a wealth tax or something like that. It's like, then why don't you just pay it yourself then? Nobody's stopping you. But, I think most of us realize that, hey, we have a legal obligation to pay the minimum amount possible. We don't have to pay the maximum amount. So we, and then understanding where you can save more of the dollars that you have earned. And
Well,
that's our goal.
no law that prevents somebody from writing an extra check to the IRS if they want to make a contribution and donation, right, Chris?
Absolutely. Have at it. Yep. And heck, you can put it toward my bill if you'd like, even.
Well, ladies and gentlemen, if you have questions, if you have concerns, if you would like to plan proactively, be more efficient with your money, control that tax bill into the future, that's exactly what Chris McIntyre helps his clients do each and every day at McIntyre Retirement Services with that game plan for retirement. He will put together that document for you. And now, this is not a 500-page document with a lot of financial jargon. This is simple, easy to understand language, concise, consolidated steps. It's actionable. It's something that you can understand and execute on in order to make your goals your reality into the future and better control some of the variables that seem at sometimes outside of our control. And we will help you address what the market risk exposure level is that you are comfortable with, that is appropriate for your situation. Chris will help you address that tax liability if you're paying too much in fees, how you can get more out of Social Security, just a few of the factors that game plan for retirement will help you better understand and make more well thought through, informed decisions on. Pick up the phone if you would like to get that now. There is no cost. There is no obligation. There is no need to meet in person, although Chris is beginning to do those in-person in-office meetings and reviews once again. So whether you'd like to meet face-to-face or through the comfort and convenience and safety of technology, Chris McIntyre will make that available and get that process started with you and for you. 800-868-1194. That is 800-868-1194. Chris, we always appreciate your time. This is obviously a very timely topic with tax deadline right around the corner. So thank you for being here as always, as our guide, helping us with our game plan for retirement.
Yeah, it's my pleasure, Peter. And just to throw out there that I have already been fully vaccinated as well.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.